you've got over 4.5, that's billion with a B, of loans under management, which is an astronomical number. Talk to me about some of the growing pains in terms of scaling the ALIC business.
We lend money to educate customers to enable wealth creation. It's about lending ethically, and to find the right people to do that takes a long time.
There's a bit of a common belief out there that you're earning an average income, you're going to get tapped out at one or two properties and then you're not able to scale. Is that BS or is that accurate?
Is it BS? It's really important from a lending perspective to understand the customer, understand their cash flows, their risk profile, their comfort levels, how they sleep. It sounds weird, but if I gave someone my debt level today, they wouldn't sleep very well tonight.
I deal with a lot of clients each and every day, and it's all well and good that the bank will allow you to borrow $2 million.
Yep.
But as it stands right now, interest rates are in the 6% range. You're going to be negatively geared on most properties, maybe $10,000, $20,000, $30,000 per annum.
Yeah.
If you've got 5 or 6 of them, there's two parts of it. Yes, you can go out there and buy all the properties in the world, but then you've got to actually keep these things afloat. Is that kind of one of the challenges that you really kind of touch on with your clients as well?
One of the biggest challenges right now is that...
What separates the clients who become wealthy through property investing versus those who plateau over 1 to 2 investments?
Good question.
Welcome to the first episode of the No B.S Property Investing Podcast, where we talk with Australia's leading voices in property, finance and wealth building. The podcast for everyday Aussies who want real, proven strategies to build wealth through property. No hype, no agendas, just straight talking advice from over 1,000 real-world property deals. Whether you're a rentvestor, a time-poor parent or chasing early retirement, we give you the tools to take action with confidence. And for our very first episode, we're bringing out the big guns, a true heavyweight. Mark Davis, founder of the Australian Lending and Investment Centre, Australia's most awarded brokerage. With over $4.5 billion of loans under management and multiple number one broker awards to his name and a golf handicap of 2, Mark is a master of helping clients use smart debt to fast-track their financial future. So whether you're a homeowner, investor, or just getting started, this episode is packed with insights you won't want to miss. All right, so Mark, I would talk to us about what really inspired you to leave the banks and go ahead and start ALIC.
Yeah, basically I was at ANZ for 21 years and loved my career at ANZ. Had an opportunity to roll out an investment division for ANZ, which is all around lending for wealth creation reasons. And the GFC came in 2009, which caused a few issues, and the bank wanted to go back to more basic lending, which is understandable. And at that time, my hand was forced to get out of the bank system and set up my own division to go and lend money to customers to enable wealth creation. So I suppose my whole dream to do it for the bank came to an end during that time, and we got out there and rolled out the company called the Australian Lending and Investment Centre.
And how long ago was that? When did you actually start the business?
2009. So worked at ANZ from 1987 as a young person down in Tasmania, and then set up ALIC in 2009 with my business partner Kevin Agent. Funnily
enough, you tell me if this is a true story. Our office down in Sandy Bay on Hobart, is that where you actually started off your banking career?
I did. I came into Ripehouse the other day and walked through the door and sat on the desk that I sat in 1987 when I started at ANZ as a young teller.
Yep.
In the Magnet Court in Sandy Bay, yes.
Yep, that's pretty surreal actually.
It was interesting.
I'm pretty sure the guys in the office sometimes get people still in and walking like, this is not ANZ, so it's...
Well, I think ANZ had only just left there a year or two earlier, so
yep.
It was quite the experience and winding back the clock.
Yeah, awesome. And then I guess, going back to your business, you've got over 4.5, that's billion with a B, of loans under management, which is an astronomical number.
Yeah.
But maybe talk to me about some of the growing pains in terms of, scaling the ALIC business to get to that point where you're at today.
I suppose one of the biggest growing pains is finding the right brokers and writers out there to do what we do. So we lend money to educate customers to enable wealth creation. Okay, and that's really solely what we do. So we don't chase home loans. We don't go and market home loans. It's all about gearing. It's about leverage. It's about lending ethically, and to find the right people to do that and convert them takes a long time. So it's one of the biggest scaling issues. The other issue is the back end, making sure you've got the staff that can actually give the back end service to get through the red tape in the bank system. Because the banks aren't easy to work with necessarily. They're easier directly. They don't necessarily look after brokers as well as they possibly could. And so to get the staff that can cut through the red tape is probably one of the biggest issues as well.
Yeah, that makes a lot of sense. I think for any business trying to scale, it's, you get a lot of orders come in, then you got to be able to actually get the cooks in the kitchen to fulfill the orders, and then you get all the cooks in, but then are they the right cooks in the kitchen? And I guess that makes a lot of sense. And I guess for yourself, you spent a lot of time at ANZ and much more time now with running ALIC. What has your background experience from ANZ, how has that shaped the way your strategy and your client experience? Like, what was that gap you felt was missing in the market?
Yeah, so I knew the investment gap was out there as an employee of ANZ. So I initially set up a business within ANZ called the ANZ Lending and Investment Centre, ALIC. ANZ Investment Lending Centre. And then we, a little bit cheeky, we set up the Australian Lending and Investment Centre and changed the colour from blue to purple. So the gap was always there, and the banks don't really hit that side of the wealth creation side of lending. They believe wealth creation is through financial planning.
Yep.
And through private bank, not necessarily through lending structures when talking to customers out there who want to improve their situation. So the gap was massive, and then I've tried to fill that gap with a person called Brian Hartz, who used to head up the Australian division for ANZ. Rolled it out, about to roll it out nationally, and then the timing was pretty bad because the GFC came in right at that time in 2009, and the banks struggled to get funding. We basically, at that stage, they closed that division down, and then it was an opportunity for me to walk out and then set up our division and go to other banks and get the funding from various other banks that were very open for business immediately.
Yeah. So, I guess one door closes, another one opens, and it's been, I wouldn't say always smooth sailing, I imagine, for you, but you must be pretty happy where things are at today, and you guys are obviously continuing to scale.
Yeah, we're very lucky. I was very lucky to work for an employer that let me follow my dream, because most banks wouldn't listen to an employee. But I'd been there for so long, and we'd been writing very big sales volumes for the bank, so they gave me the opportunity. So I'll be very thankful for that. And then to go out and do it again, no regrets, no looking back. We want to change the way lending's done in Australia. One of my goals is to change and have all people and all customers to understand their net worth, their retirement age, their current structures, their current assets they own, and really educate them from a lending perspective, and then get them around the people that they need to talk to on the things that we can't advise on. So that's been my goal from 25 years, 30 years. And we'll keep pushing along.
And you touched on a good point there. So I guess for yourself, you're saying for a lot of brokers or brokerages out there, you're pretty much saying like you need a team around you. Is that right? It's not just about you maybe you're one piece of the puzzle. Is that what you're trying to educate your clients on?
Yeah, there's certain things we can't advise on. Okay, we don't want to be a property advisor. We don't want to be a financial planner. We've studied planning, but we don't want to be a planner. We want to be the best lender from an investment strategic perspective to enable wealth. So it's a bit of a cop-out. We lend money to enable wealth. We don't create the wealth.
Yeah.
The people that create the wealth are people like Ripehouse, who know where to buy the assets, have all the data. You need a set team around you, and they have to be wealth-oriented. Okay, so anyone out there with teams that aren't wealth-oriented, or an accountant who just does a tax return, or a broker who just does a rate, or a buyer's advocate who just buys a property, basically we try and get the right people around all our clients.
Yeah, and I guess, so going on that a little bit, I guess what's the whole ethos about the Australian Lending and Investment Centre? I guess what's your philosophy? What are you trying to bring to the table for clients? Like, what do you guys? I guess what do you stand for? What do you want your? Every business has got their mantra or their vision board. What does that look like for the ALIC business?
It's a good question. Ethically lend. Don't lend as much as you can. Don't look at borrowing capacities and go to a bank and say, how much can I borrow?
Yep.
To reduce non-deductible debt. To loosen the noose around the client's neck. If you get non-deductible debt reduced, it frees up cash flow. It frees up lifestyle. It frees up the ability to be able to invest and holiday and retire early, and you can start making decisions. So the whole ethos is improve your financial position, reduce home loan debt, which is quite the opposite to most brokers or banks. Reduce non-deductible debt, increase deductible debt, get your money working smarter, do it in a timely fashion, get the right people around you, and structure to enable wealth.
Yeah.
And that's really the ethos from day one, and that we continue with.
Yeah, and that you touch on a really great point there, and one of my kind of pet peeves, because I'm kind of front facing like yourself. I deal with a lot of clients each and every day, and it's all well and good that the bank will allow you to borrow $2 million.
Yep.
But then there's as it stands right now, interest rates are in the 6% range. You're going to be negatively geared on most properties, maybe $10,000, $20,000, $30,000 per annum.
Yeah.
If you've got 5 or 6 of them, and then you're trying to put kids through private education, you're trying to go on the yearly holiday or so. Like there's two parts of it. Yes, you can go out there and buy all the properties in the world, but then you've got to actually keep these things afloat. Is that kind of one of the challenges that you really kind of touch on with your clients as well?
One of the biggest challenges right now is that everyone's above the cap. Okay, so if your borrowing capacity was that before, and then rates go up 18 times, your borrowing capacity comes down 40%. So you've got a big percentage of the population are above their cap right now. And you've got to manage it back under the cap. And how do you do that? Through exits, through reducing non-deductible debt, increasing income, bonuses, all those types of things. So there's ways to get back under the cap or using second and third tiers. So it is definitely an issue out there, or a problem out there, that people have all these expenses, have these lifestyle things, they feel the pressure. But to me, it's about, if the banks aren't lending and your caps come down, what are we doing about it? We should be discussing it. We should be getting exit strategy. We should be bringing the buyer's advocate, Ripehouse or someone like that, or your buyer's advocate, to talk through the asset. So the last 2 years, 3 years, as rates have gone up 18 times, it's gone up 16 times, at equivalent to 18.25s. All our conversations are about really getting back under the cap and getting into the control where we can actually manage your structures again. So I don't know whether that's answered your question. Does that answer your question?
No, it does. It does. And then I guess, you raise a good point. And what I really love about your business is I think in the property space, as investors, we almost become hoarders. We love to collect properties, and it's just about, now I've got 5, I've got to get to number 6. And we feel like if we go from 5 or 6, we sell one of those properties off, we've taken a backward step. Yeah. But, that's not always the case, right? If all of a sudden you free up non-deductible debt, and we get clients come through the door, they maybe want to start off by having a passive income, quote unquote, of 150K. But when clients come in, if they've got their home loan paid off and they're able to go on, reduce it, that they're only working down 3 days a week, they're able to go on more holidays. Yeah. That's not what the 150K isn't what they're chasing, right? Yeah. What they're chasing is choice. Do you feel for your clients that's the big one? Because obviously you've been doing this for a long time, and you've got clients who are, we've worked with lots of your clients where they're either at the early stage or in the middle part, or we've got lots of clients also at the back end where they're actually starting to sell off assets and walk into retirement. Has that been something, maybe you can touch on the education piece you touch on with your clients?
Well, a lot of people will just, like you said, go for 5 to 6, and they think they're advancing because they're growing their property volume, okay? And that might be a lot of Europeans. The old mentality years ago, the Greek corner store owner would be really on 200K a year. His tax returns might not show that, but he has 6 or 7 properties and just holds for 30 years. And he's missing out in markets. Okay, so I'm a big believer in not staying in markets that are underperforming. Classic example, and not that we're the property advisor, and you know this better than I do. Tasmania is going through a bit of a period at the moment with no growth in certain markets. You've got Bendigo and Ballarat had 10 years of no growth. You had Perth 13 years of no growth. Why would you ride through those markets when you could have gone to other markets? So ALIC we're buying everything in Victoria 8 years ago. We've hardly bought anything in Victoria from an investment level in the last 8 years through our buyers advocates, because there's been better markets in Adelaide, Bendigo, Queensland, Perth, etc. So hoarding, as you asked, I'm not a massive believer in it's how many you own. It's about what it costs to run your portfolio. What's it cost pre-tax? What's it cost post-tax? What's my buffer? Okay, what's my non-deductible debt? How much pressure's on me? What noose have I got around my neck? And I can tell you, families out there now feel that noose. If you go to Sydney, a lot of the non-deductible home loan debts are massive. The pressure they're under to deliver for 30 years is insane. And I believe there are better ways to get around that. Not necessarily go to your big owner-occupied house. Can't get your big home loan debt because the bank said you could borrow it. Who cares what the bank says you can do? Okay, it's about understanding all the facets of it, and then making the right decision to own that house outright sooner and earlier.
Yeah, and you're touching on that now, because I guess from our clients we see, particularly couples coming in late 20s, early 30s, this shift of having to go out there and buy the $1 million property with $1 million loan, or the best part of it, and all of a sudden their repayments per month are about $6,000, which is 60-70% of their income maybe for some of them. There's been a real shift where they're happy to rent and go down that rentvesting pathway. I guess maybe talk to me a little bit about, in types of, I guess there's also clients out there that become fixated on paying off their home loan, rather than going out and buying an investment property and, just paying an extra couple of $100 per week and getting the debt down.
Yeah, it's the old style, isn't it?
Yeah.
It's the old way the parents say, the Australian dream, buy your first house and get in the market, and just pay it off. And that's what I was taught by my parents. So I opposed. You either follow your parents or you oppose your parents, yeah, in most cases. So I don't like getting on the treadmill. I don't want my clients on a treadmill. I don't want them paying the bank home loan payments of $6,000 a month for 30 years. I think that's just an absolute waste of money. There's other ways around it. But that's an emotional choice to go and do that. So it's about controlling and making decisions around non-emotional things and trying to get the emotion out of the calculation. And if we can get it out of the calculation, and don't go and buy a house in X suburb that you wanted to because the bank said you can do it. Okay, go and rent in that area. So I'll give you a classic example. You go to Camberwell about 12, 13 years ago when we started doing this a lot with ANZ, or maybe 15 years ago. You could buy a $2 million house in Camberwell, or you could rent the place for $650. Okay, so we got all our customers living in Camberwell, rent-vesting, paying $650, having a massive block, great for the family, near the school, in the school zone, awesome lifestyle, and they invested elsewhere where they can make money. So rather than go and get a 1.75 home loan debt at rates of 10% at the time, that was costing $11,000 a month, they could actually live in the same place for $3,000. So anyone out there who says renting is dead money, that's a classic example that rent money is the best money ever.
Yeah, and I guess it's really taking that leverage, right? Like you've got some advantages as an investor.
Yeah.
We've got negative gearing to tap into.
Yeah.
Or we've got the leverage aspect in terms of, the bank's going to give you back, about 5-6 times your income at the moment. And then also too, if you're renting or you're renting your property out, that income is coming to help your servicing, right? So, and that's what's fun. And then I guess that touches on the next question. I guess there's a bit of a common belief out there that you're earning an average income, you're going to get tapped out at 1 or 2 properties and then you're not able to scale. Is that myth? Or I guess because, the theme of the podcast is, no BS. Is that BS in terms of how to do that or is that accurate?
Is it BS? There's a whole lot of bullshit, really, to be honest. You can't keep borrowing. Okay, the government don't allow you to keep borrowing and the banks don't allow you to keep borrowing. And if you can't borrow, there's probably a reason why you shouldn't be borrowing. Okay, but there's a lot of people out there that do want to keep borrowing and go over their cap, and they're not that experienced on investing and they get themselves in trouble. Okay, so I'm a big believer. If the banks are saying no, there's a pretty good reason for it. Okay, but you can use second tiers. We can use third tiers. We'll touch on trusts later. You can use trusts. There's reasons for and reasons not to. But in summary, you can't just keep buying properties. Okay, but you can buy a lot more if you reduce non-deductible debt. So non-deductible debt we call shit debt, bad debt. It's horrific. It's paid from your net income. It's post-tax money. If the government's going to give you a 45% discount, why wouldn't you take it? Okay. So rent vesting's been massive for me. I started investing at 21. Been investing for 34 years or whatever. 34 years now. And I believed in rent vesting back then. Okay. It's becoming bigger, and so moving forward, kids won't have options.
Yeah.
So if your parents can go guarantor and you rent vest and you buy in a growth market, let's turn your 20 grand into 100 grand. Okay. Let's then turn your 100K to 250K. And the biggest, hardest part of it all is how do we get that first 250K? That's the hard bit. The next 250 or 500 is easy.
It's like a snowball rolling down the mountain, right? Like once you get that snowball rolling, it's just going to get bigger and bigger from there. But the hardest part is starting. And if you've got, like you mentioned, we've seen the banker mum and dad getting more and more tapped into right now. I think there was an article out there the other day that the banker mum and dad now don't even expect to get their money back. So that's the big one as well. It's becoming a bit of a theme. So it's just getting into the market before it becomes.
And just on that, where's the risk to the parents? Okay, so say a parent owns two parents. Or a parent owns a property worth $2 million. So they own the majority of it. One of their kids come in at 20 years of age, got their first job, got 20K saved up. Okay, no one thinks they can get into the market. Property's too expensive in Australia. I can't get anything in Melbourne or whichever state I'm looking at. But you actually can. You can go to someone like Ripehouse or a buyer's advocate to talk about and buy in a market around the country for $350,000, $450K with 20K. Okay, because banks will lend if the parents are going to go guarantor. The parents aren't putting cash in. They're just guaranteeing, say, 120 grand, that if things went bad and the loan went bad, you didn't talk to us, you didn't talk to the bank, we had to sell it, the guarantor ignored it, we sold at a loss, and then the guarantor could be up for 120K. Now, in 30 years of my lending, I've never seen it.
And even from us, from a buyer's agent's point of view, I've never seen a client's purchase lose money, particularly when buying costs over the last few years are up about over 50%, right? Yeah. So if you're buying a property, 350, 400, even 500, your risk is really low because to build the same thing like for like these days is probably going to cost you $500,000 or more. So,
if the data's right from you guys, which
Yeah.
it is 99 times out of 100, okay, and the data's right, the asset's right, and if you do get into trouble employment-wise or salary-wise, then speak to your broker and talk through it and take it out of the control of the bank. Never let the bank get control of this, okay? And then you manage that situation, and you may have to exit. There'll be various options, but you normally work through it. But again, I haven't seen a client get into trouble in 30 years.
Yeah. And I mean, you touched on it just before in terms about your experience of property investing. We haven't gone into that much so far. Maybe give us a bit, I know, because you're a highly successful property investor yourself. Maybe give us a bit of your background, or as much as you're open to discuss with, in terms of how you started, what are your learnings been, and where's your portfolio at today?
Yeah, it's a good question.
If you're serious about building wealth through property, you don't just need a loan, you need a strategy. And that's exactly what the Australian Lending and Investment Centre delivers. Australia's most awarded brokerage. They're not just looking at what you can borrow, they'll build you a holistic lending plan tailored to your long-term goals. We use them, we trust them, and so do our clients. So to find out more or to book your complimentary lending strategy session, head to the link in the show notes to connect with the team. Thanks for listening. Now back to the video.
Happy to share. Okay, I share with all my customers all the time. If I'm going to run meetings and get information from clients, I think it's fair that you share what you do as well. And I think it just enforces to the customer that you're also doing what you're preaching. So I started investing at 21 in Tasmania, where I grew up. Okay, pretty average market, didn't use professional advocates, made all the errors, which we all do.
Yep.
Thought I knew what I was doing, made a loss on a property, my first property, only property I've ever made. I've actually made 2 losses out of 40 properties. There's a couple of reasons we'll talk through, but I made a loss on a small property in Moraine, bought it for $63,000, sold it for $58,000 7 years later. Got trashed by the worst people.
Yep.
Okay. And this is where most investors will walk away and go, got burnt, got trashed, didn't work, won't do it again. And that's the problem that most people have. They don't get back on the horse. And then bought one in Bellareve, which is right near the Bellareve Oval, and then moved to Melbourne and then started buying investment properties, but always loved it and wanted to do it. And then buy on average 1 to 1.5 a year. But you've got to show the income to keep borrowing. So to answer your question earlier, can you just keep borrowing? You can't. You've got to show income. Okay, and you've got to meet the guidelines and the requirements. There are ways around with second and third tiers and things like that, but you've got to basically continue your income growing to keep borrowing. But also I'm a very big believer that you don't move into your first house. So I'm a little bit different. I waited to 45 to move into my first house.
Wow. So that's delayed gratification, which I think for a lot of people out there, that's a newly learnt skill, or a skill that they need to probably build on.
Well, so, I figured that if I can go and live in a place that's better than what I can buy, why don't I do that and just keep investing in the right markets? Yeah. And it probably went out of hand, but the house I ended up buying was a place in St Kilda West, and we bought it for 3.4. And it was a 5.5 house, negotiated perfectly in 2015, 2014 when GFC2 was coming on and all the execs, the banks were losing their jobs, all the margin calls were happening. And it was quite messy. And we got I negotiated a $2 million discount. And then went home, said to my wife, we bought a house, but we can't move in.
How did that go down?
Didn't go down well, but she understood, because all these other properties we had were mid-strategy. Okay, so you don't sell them mid-strategy, or and some of them we just bought. So I said, we'll go and rent it, we'll gear it, and we'll also renovate it in 2, 3, 4 years once the other properties have gone through their strategy. And then you offload those assets to do the renovation, then you offload the assets to own it. So I sold 5 to buy it, I sold 5 to renovate it, and then 5 to own it. So I've sold 15 houses to own that house. And then happened to sell it for 11.2 million 6 years later.
Just a small little profit there.
Little $5 million profit, tax-free, which was nice, or close to tax-free. There's a bit of tax to be paid for the first bit of time it was a rental. And it was that was probably my best performing asset. What's interesting about it, which you'd like to know, Julian, is that I got advised by my advocates at the time, do not buy. It was between 2 apartment blocks in St Kilda West on the water. There was a 3-story one on one and a 9-story on the other. And I knew I could renovate the house in a way that it wouldn't be affected. And we did all the renovations, spent $3 million on the renovation, and did it in a way, and then sold it at the perfect time, 2021, June 30.
You were pretty much been selling right at the peak of the market because it didn't really do a whole lot. And even still today, the $2 million plus market in Melbourne hasn't quite recovered. So you basically exited the right exact.
Probably worth less now.
Yep.
Okay. I don't know exactly, but I think it is.
Yep.
But June 21, June 30, stamp duty in Victoria pretty much went up 30% that day, and it got on the news. And it was front page on the news that day. The last property that was sold in Melbourne, June 30, at the reduced stamp duty, and the purchaser saved about $200K stamp duty, which is so perfect timing. But that's my investment story is probably the best one to that. But I own quite a few assets all around the country, and just started a development the other day in there you go. I went in with a joint venture with some friends there. Is it Ashgrove?
Yep.
In Brisbane. I've only moved here 3 years ago, so I don't know all the suburbs up here still. And we're just doing a development there, and we want to get into some bigger stuff. But mainly my investment strategy is buy, hold for 3 to 6 years, go through the market, exit, reduce non-deductible debt, and just get your money working as hard as you can in the right markets.
Yeah. And so you've got a clear strategy for yourself. Maybe talk me through, I'm a first-time customer coming to the ALIC business or to sit down with you.
Yep.
What do you do with them? Like, what does it look like? What's the experience? What are the questions you're asking? And I guess, what are you trying to make sure that the client's walking away from that meeting?
It's really important from a lending perspective to understand the customer, understand their cash flows, their risk profile, their comfort levels, how they sleep. Sounds weird, but the customers have to sleep. And if you've got debt, if I gave someone my debt level today, they wouldn't sleep very well tonight.
Yeah.
Okay. And I wouldn't have slept well years ago with that debt level. So it's about educating and starting to understand that. But understanding their cash flows, their assets, their retirement age, their aspirations, their what they want to do, even their partner to a degree. Is their partner in the meeting? What's their risk profile? What do they want to do?
Oh, that's a big one. I'm a huge, I've, particularly for couples, you've got, I find it normally a two sides to the story with that one, where I've got the husband and wife together. The husband, he wants to become, a multiple property millionaire overnight. And the partner's like, well, I just want to get this home loan paid off, or I want to upgrade the house. Yeah. And I don't want to take on the risk. It's a bit of a juggling act on that side as well.
It's a bit of a problem. When there's two different risk profiles there, not a great sign for property growth or leveraging into various different assets, but you try and get them aligned. And we're all built differently. So we try and align them to a level. So the other types of things we understand about the customer up front, I think it's really, really important to dig deep on that. In the first hour is really understanding where we're going, what we're trying to achieve, okay, and who they are. And then, again, not over-lending, not understanding that you don't need to understand their maximum borrowing capacity. You should be able to understand from the conversations what they think they should do, okay? And then the next side of it is who's around them. Who have they got, okay? Is it a family? They've got a certain risk profile because it's family experience or family problems with maybe assets they've lost money on. Do they think a certain way because of that? Do they have the right accountant? Do they have the right property person? Do they have the right wealth people around them to advance them? And in most cases, they don't. Okay, so then it's about getting them in front of those people, and then we gather that information, bring it back in after probably 2 weeks after our first meeting, and then we start to set up the lending strategy for them, subject to what they've thought about, what they both want to do. Both, I say both, because it can't be,
absolutely.
Can't be one.
Yep.
And then what advice they got from the people on the things that we can't advise on.
Yeah. And then I guess touching on that, because I've had the pleasure of working some of your clients. I'll keep their name off the podcast for privacy reasons, but one of them, modest income, but he's sitting here with 4th or 5th property into his portfolio, which, most people listening is go, there's no way doing this by myself. I can get to 4 properties, but it's it's a time thing, making the right choices. He's got a team around him. I guess from your experience dealing with, thousands of clients over the years, what separates the clients who become wealthy through property investing versus those who plateau over 1 to 2 investments?
It's a good question. A lot of people get burnt, like past experience from family or what they've seen, or they've bought an asset. I spoke to someone yesterday who got burnt on a property many years ago when Queensland rolled out a massive amounts of apartments. But if he had that asset today, it would have done 170%. Okay, but got out early. Yeah, so what separates? It's a good question. He hasn't trusted it, or didn't stay in the market long enough. And a lot of people will just go buy 1 or 2 and won't go any further because they've got a capacity of how much they think they can borrow. They're thinking about the number they owe, not how it runs.
Yeah.
Or they've been burnt.
Would you say repetition comes into it? Like, in terms of, of seeing you firsthand in the gym, you used to be there every single day, same time, putting the workouts in, and now it's the golf course or I've heard you've got a pretty set up simulator or the golf course in the office.
I used to.
Also about the repetitions in terms of, getting in front of your team, having a review of your finances.
Of course. The more you go into it, your risk profile changes.
Yeah.
So I see my customers' risk profile change from the first meeting to the second meeting to the third meeting. I had a client this morning who, they're 50 years of age, bought a place in Tasmania, moving there in a year's time, never invested in their life. And now they're thinking about leveraging up to 85%, buying another one, sell their house in Melbourne in 2 years' time, re-gearing the asset if they decide to hold it when they get the advice from you guys, whether we should hold it or don't hold it. And they've completely changed. So that's just this morning, their whole profile and how they think about money and cash flow. So that's what it is. And the more you do, the more you understand it. Okay. So I suppose those people that stop after 2, they don't really understand it, or they've got nervous, or they've had a slightly bad experience. Yeah, and the person you and I both know had a bad experience, and his wife wasn't, and I won't mention names, his wife had a completely different risk profile. They're not together now.
Yep.
Okay, but from an investment level, I always had a challenge in regard to getting them both aligned, and they didn't invest. So they've missed out in the last 8 or 9 years of investing in the market due to one bad experience. So imagine what they could have done with, you look at the Queensland market, you look at Northern Queensland, Southern Perth, Bunbury, Mandurah, Rockingham,
Adelaide's gone crazy.
Like, it's ridiculous what money he could have made if they were just open to it. So those people they're not trusting their advisors, and they're probably going there more their gut feel, or they just can't get over a slightly bad experience they had, which is normally the problem that a lot of people have.
Yeah. And I guess we're definitely going to have to get you on for another episode, Mark, because we've only really scratched the surface today in terms of digging into all the knowledge you've got up top from your experiences. But I guess for people listening today, what are some key takeaways if they want to get in front of your team or thinking about buying a property to invest in? What do they need to do to reach out to you guys?
Look up me or look up our Australian Lending Investment Centre. Send an email through. We'll get an appointment booked in. We normally get our customers in within 2 or 3 days. We look after customers. ALIC is predominantly a customer for investors. Okay, it's people that want to make a difference, people who want to grow net worth, people who want to retire earlier, people who want to be smarter with their money, people who want to be strategic. We want those customers. Hence why we didn't advertise a market for a long time. So if any customers out there who want those things, just make contact with us through the website or our details. And just to give you some heads up on that, we don't necessarily have to write a loan to make contact. It might be there's nothing we can do right now. There's nothing you should do right now. And it's us putting a team around those people. Okay. And ALIC don't take kickbacks for that. We don't want money. We don't want motive. We want it to be very fair. And then,
which I'll jump in there. Yep. That is extremely rare in the industry we work in, might I add. So it speaks volumes about your business.
Well, I just don't believe there should be motive. We want to be the best investment lender we can. We want you guys to be the best property advisor. Okay, we want the next accountant we send our customer to be the best wealth management accountant. So if we can run it and not get kickbacks and no motive, customers feel more comfortable. And even if it's just that and we deliver that to them and there's nothing in it for us, then we're actually fine with that, because the customer will normally know other people that want help, and they always come back at some stage if they trust the information that we're giving them.
Yeah. Awesome, Mark. Well, it's been an absolute pleasure to have you in, the VIP guest for our first episode. Looking forward to getting you back in for the next one where we'll go into some more detail, and we'll catch you next time.
Thanks for having me.
Thanks for watching. If you want to avoid underperforming acquisitions, grab our free suburb performance report below. It's packed with data we use every day to guide our clients.